Okay, everybody, we are doing a review of the markets of April the 6th from Friday. And as far as the markets, what happened overall is that the markets gapped down in the morning and then slowly floated back up. Apparently, the earnings on FFIV, which you think about it, losing 16% overnight, these earnings had a really big effect on the markets, and out of all the major indices, the Qs were down the most. Obviously, the Qs were down 0.8%, the spiders 0.45%, Dow Jones 0.28%, and the IWM small caps, the Russell 2000, 0.2%. Okay, and so FFIV came out with their earnings announcement, and they pretty much missed on everything, and they took along with them other key players in the same niche, like Cisco, Citrix, IBM, even Apple. Actually, when you think about it, Apple was down 1%. HPQ, for example, 1.48%. Google also 1.5% down. So we're seeing continued weakness in tech. So it's not something that we saw just yesterday. I've been telling you guys how we've been seeing these bearish consolidation patterns, how the market kept going higher, and as a matter of fact, we had a new all-time high on the spiders last Tuesday, this week on Tuesday, and yet the technology sector was for the most part unresponsive to that. It wasn't doing anything. And Apple, of course, being the leader, being the indicator, it was one of the worst performers, okay, in the whole entire tech sector. And then this final blow to the tech sector was the FFIV earnings, okay? And so I wouldn't jump on the tech sector now. I wouldn't go long now, because there's going to be a little bit more confusion, maybe a little bit more downside, but I would just let the pattern play out and then see if you can go long. But now the way that I see that, the way that things are shaping up, I think if you were to buy anything in the tech sector for a longer term, like a week plus, if you were to buy anything in the technology sector right now, I think you would be overpaying, okay? And not only that, you have to understand that the market is at all-time highs. So when the market starts reversing, the tech sector is going to go down first, because it's the weakest one that we're seeing right now. And so don't get caught up in a long. That's what I'm saying. If you have to be in a stock, it's better to go short, okay? But don't go in blindly. Have your specific levels and only take your shorts or longs. If you see a good setup, only take them when everything is aligning, when you see your patterns, and when the market is aligning as well, okay? Now, that was about the tech sector. Now, another thing that we had on Friday was a jobs report. I think, I'm not sure what it was. I don't really pay that much attention to it. I just see if the market reacts, good or bad to it. And the jobs report, or the unemployment numbers, or whatever it was actually a bad report. There was all this negativity out there in the news, how this was a bad jobs report. And the interesting thing is that if you look at the major media outlets, what they did on Friday after this report or number or whatever it was, after it was announced, they started bashing the Fed. They started bashing the Fed for announcing, if you remember a couple of months ago, they announced that they will eventually phase out of QE, and citing that the economy could take care of itself. Which is kind of interesting when you think about it. Last September, the Fed announced that the QE would become unlimited. Okay, so in other words, when the Fed announces that QE would be unlimited, what does that mean? That means that the economy is in a very poor shape, right? Otherwise, why would you be injecting all these billions and billions of dollars every day if the economy was doing well, right? So they announced last September that QE, this quantitative easing, would become unlimited. And since then, the market has rallied. Obviously, markets like to be stimulated, and that's really what QE is doing. QE is stimulating the markets. So now that we're at an all-time high, now all of a sudden, Fed came out a couple of months ago and said, we will eventually start phasing out this QE, okay? And the logic behind that, well, the economy is improving, right? If the economy is improving, you don't need any quantitative easing. And so that was just, 1 day or 2 days in the news. And now, finally, we are seeing the repercussions of that, okay? We are seeing, earnings reports. We saw FFIV. We saw Oracle a couple of weeks ago. Numerous other news as well, like for example, I believe in February, a Walmart executive came out and said that that particular month was the worst month they had in I don't know how many years. So we're slowly seeing the repercussions of this QE. So what this is telling me is basically is that we are drunk on QE. We need QE, otherwise we're going to fall apart, okay? It's kind of like a house of cards, really. Our economy is like a house of cards right now. And so if you take out that QE, what did we really achieve? And the funny thing about QE that a lot of people don't understand is that QE itself costs $85 billion a month. A month. In 30 days, we spend $85 billion on QE. And, I know everybody's talking about this sequestration and how, we need budget cuts and all of that, that went into effect last month. Well, do you want to know the reason why the sequestration didn't affect the market? Because everybody thought we are getting into March 1st, the market is going to start selling off drastically, and then all of a sudden we noticed, well, we're not hearing anything out of Washington. I guess they're just going to let this be. And then the market just held up, and as a matter of fact, we put in an all-time high a couple of days ago. The reason is because this sequestration is really overhyped by the media. It really is. Because this annual sequestration, this amount of money, okay, that is that we will save apparently in this sequestration, okay, a whole year of it, okay, is worth a month of QE stimulus. So it's kind of funny that they're talking about sequestration and letting our taxes expire, tax cuts expire, and all of that, and then yet on the other side, in that murky area where nobody's looking or even bothering to investigate, the Fed is spending $85 billion a month. They're spending this whole entire thing that they're imposing on us, the sequestration. They're spending it on QE in 1 month. And that's the reason why the market didn't sell off, okay, on March 1st. Because it was negligible. It was just overhyped by the media. It was just something that looked good on CNN or on CNBC, and that's why it wasn't a big deal. The big deal is the actual QE. The big deal is this $85 billion a month, okay? So that's the real problem here. And it will be interesting to see what exactly is going to happen, because, at what point does the Fed come out and say, hey, listen, we made a huge mistake. We need to do something about this. And in my previous videos, I kind of have a little bit of a little anecdote for this. This QE and what the Fed is doing, it's kind of like pushing dirt underneath a rug and not vacuuming it, right? So there's a problem, but you're just going to push it underneath the rug. But eventually you're going to get more and more piling up, and you're going to trip over it, right? You have to vacuum it eventually. And that's exactly what they're doing. And eventually, I'm pretty sure there will be a probe. These guys are going to be all over the news somewhere, Okay? They're going to be in front of Congress, and the very same people who approved for them to do what they're doing are going to reprimand them. And that's politics. That's all it is. It's politics. It's, you know, saving your own back, really. But the problem is that we the citizens, we're the ones that pay for it. Okay? And every citizen now, every American owes, I think, about $53,000. So every individual, I don't care if you're 50 years old or 5, okay, if you even don't know how to speak yet, you owe about $52,000 because of all of this debt that we have been accumulating. Okay? And so when they talk about sequestration and all of these things in the media, okay, don't get sucked into it. You know, go online and do your research, figure out how much the numbers really are, because more than likely that story that you're hearing is covering up another story. So sequestration was basically, to me, it was a scapegoat to this QE. Okay, so now when things go bad, you know, now that we're starting to see all these earnings report that are doing that are coming out, and they're very bad. We're seeing these bad jobs numbers, and you will eventually see worse things. And you know, I guarantee you that. You know, just watch out the next couple of weeks as these earnings commence. I'm pretty sure a lot of them are going to be really, really bad earnings. But the market is going to blame that on sequestration. The market is going to blame that on these budget cuts. Okay, it's going to blame that on tax cuts. And you know, retailers are going to do their own thing. Retailers, you know, when they come out and they have their bad earnings, they're going to say, well, we haven't sold enough because of these tax cuts, you know, that went into effect on January 1st. Okay, that's great. But again, like I said, this is negligible. You have to look at the real problem, which is QE. Don't, you know, the sequestration is a scapegoat. That's what they're using, because if you think about it, what would you rather, if you were the market, what would you rather blame? Okay, what would be your excuse? Would you say we are having tax cuts and therefore we are not selling enough of these units? Or would you say, well, you know what, we're spending all these billions of dollars stimulating our economy and we're not getting anything out of this QE, maybe we should cut QE. You're going to say the first thing, obviously, because QE is what keeps your stock price high. You know, that's the reason why Walmart and Target and all of these companies are at all-time highs, because of QE. So they're not going to blame the very hand that feeds them. Okay, they're going to use sequestration to get even more stimulation in the market so that they can pump their share prices even higher. So if you see, you know, in the next couple of months, if you see some reference to sequestration, be aware that it isn't really about these tax cuts or anything like that. That's a very, very small cut compared to these $85 billion that QE absorbs every month. Okay, so just kind of giving you a heads up so you don't get sucked up, you know, in the media. So, you know, do your own research and use your own brain here. Now, you know, even though, you know, we had these jobs numbers on Friday, and you know, the way I look at it, either way it's bad for the economy and even the markets also. Okay, because for one, the Fed announced a couple of months ago that they will be phasing out QE. Okay, and then we had the jobs numbers on Friday. So bad jobs numbers are bad, apparently, right? They're bad. So when you have bad jobs numbers, that should technically tell the market to go lower. But here's kind of the catch in here. Up until now, okay, in recent months, we haven't really had, you know, a lot of great numbers. You know, when you really do your research, these numbers weren't all that great. But even when we had bad numbers, bad economic data, the market still rallied. Just look at the chart of the spiders in the last 4 months or so. You rarely had a really big down day. And the reason being is that if you have a good economic number, obviously market goes up. If you have a bad economic number, this is telling the markets that the Fed will come in and save them and inject QE, okay, into the markets. So either way, even if you had a bad number or a good number, Fed was going to come and rescue you. And that's why the markets have been rallying. But now that we know that the Fed announced that they will eventually phase out QE, and we're starting to see proof of that, now it makes me wonder if next time we get really bad numbers, that the market will actually sell off because it knows that the Fed will not save it. Okay? Because think about it, what is left for the Fed to do anymore? And like I said, every person is in debt $52,000. What are they going to do? Put us in debt $100,000 each? Okay? I mean, at what point do you say, hey, listen, stop, I can't afford this anymore? And so, we're just kind of, what we need to do now is look for clues to see where we will pass that threshold where, something happens that makes this QE no longer justifiable. And so look for clues. Obviously we're seeing more and more bad earnings reports. We're seeing jobs data, and look for other things like housing data. And although a lot of these reports are going to be manipulated, and they're not going to be verifiable or make much sense to us, because a lot of them, what happens with these reports is that they'll come out and the report will be really good, and the market will react immediately, but then after a month they go back and they revise that same number to be the actual number, which is worse. Okay? And of course the market doesn't care about a report that was from a month ago. It only cares about what's out in the news today. And I really don't like that, because give me the real number now. What kind of statistical analyses are you using? What kind of resources are you using to not be able to actually come out with the numbers? Okay? Don't go back a month and say, well, we forgot to add this or that. Just have a set date. I'm starting from here. I go 30 days from then, and I will count everything in between, and that will be the number. But unfortunately what they do is they give us the good numbers first, and then they revise it after a month to be the actual realistic numbers. So if you see those numbers out in the news, be careful. It's not always as it seems. And also another thing, on Monday I believe the Fed is going to announce interest rates, and just looking at the direction in which we are headed, it just seems like they will have to raise interest rates, because this QE is not working for us anymore. We can't print our money out of a bad economy. So they will eventually have to start raising interest rates, and I wouldn't be surprised if they start putting more pressure on the banks, if the Fed and the government start putting more pressure on the banks. And if you look at a lot of the charts on the banks, let me just pull up JPM, just a random chart on the daily, you'll notice that and like I say in all my videos, the banks have already started rolling over last month. They put in their top around the middle of March for the most part, and they have been going lower and lower and lower. Okay, all of them. You can look at any other bank. They have been doing the same thing. So there is this negative divergence, between the markets and the banks. And one particular chart that I always refer to when I'm looking at the overall picture of the market is the XLF. Okay, and the XLF is the ETF that tracks the financial sector. It has about 30 or something banks in there, but this is a good indicator because it's very symmetrical. The XLF is a beautiful chart, And I'm gonna have to pull up the monthly because I want to go way back in time. Now the XLF around March 2003 has been rallying higher. However, in June 2007, that's when the market started selling off drastically. And then in March 2009, we started creeping back up. Okay, but notice how this float right here is very weak. And you know, just look at the spider. The spider is at an all-time high, whereas the XLF is putting in a bearish consolidation pattern. Okay, so I think banks are overdue for a major sell-off. Okay, I don't know when that is going to happen. My projection is that by July we will see some significant selling in the banks. Okay, it might start immediately, but I think ultimately by July we should see some cracks in this ice as far as the financials are concerned. So keep watching the financials. Okay, now another thing I want to talk about is the retailers. And the retailers are very interesting because there's a divergence within the retailers themselves. You have charts like Target, Macy's, Walmart that are very strong, okay? And actually, let me keep it at, let me put in the weekly, not the monthly. But, you know, if you look at Walmart, for example, Walmart, all-time highs. And a lot of other retailers are also at all-time highs. And, you know, if you look at other charts, which I'm not going to go into, look at the XLP and the XLY, which is, you know, the retail spending. And, you know, these charts are just through the roof, okay? They're very hyperbolic. So retail spending, since we've been in this particular bull run, has been very hyperbolic. And of course, charts like Walmart and Target, you know, they're at all-time highs, okay? However, I think that they're ready to put in a top and roll over. My major reason is the markets. So obviously, if I think that the markets are going to roll over, then for the most part, everything else should go with it, right? The other reason is that overall, retailers have been hyperbolic, and eventually, if you put in, you know, and let me just look at the XLY so I'm not just talking. If you look at the XLY, for example, the discretionary ETF spending, now look at this one. It's at $53. It was, what, $15 in 2009. So it went from 15 to 53 in 4 years. So these charts are just to me screaming that they're overdue to roll over and to pull back. Okay, now as far as divergence though, and that's the interesting thing, a lot of those charts for the retailers that have hit those highs are starting to slowly roll over. Let's look at JCPenney, and let me go back to the daily chart. Now JCPenney, if you zoom out, okay, has been very weak, okay? And for years, actually, ever since we started recovering in 2009, JCPenney has had a hard time recovering with the markets. And if you zoom in and look at the near term, you see that JCPenney is putting in a bearish consolidation pattern. Okay, another one I want to look at is DDS. Okay, Dillard's. Same thing, very similar to JCPenney. And so, you know, even though they've put in this this high right here, okay, so if you zoom out on Dillard's is different from JCPenney actually. Dillard's does have that hyperbolic move like all the other retailers have. However, Dillard's has this bearish consolidation pattern now, and the only thing keeping it there right now is this orange line, which is the 20 MA. Eventually though, it's been on this around this 200 MA for a good enough time, and it looks like Dillard's wants to go lower, okay? And so, you know, look for these retailers. I'm seeing these I'm slowly seeing these divergences. these bearish consolidation patterns, okay? And the interesting thing is that next Friday, Friday of next week, we are going to see some have some retail sales data coming out. So be on the lookout, because that might be the trigger point for these kinds of bearish consolidation patterns to go lower, okay? So watch for that retail sales report on Friday, and maybe even these patterns start breaking down on Wednesday or Thursday, okay? Because the market tends to know ahead of time, when what a report is going to have in it, okay? So later on next week, watch for these bearish consolidation patterns, okay? And also another stock that is having earnings next week is BBBY, Bed Bath and Beyond. So watch their comments to see if they say anything about the economy, and maybe that will have some predictive value as far as going into the future. And on these other charts, like JCPenney and Target and all of that. As far as next week, another company that I like that is reporting on Wednesday is Ruby Tuesdays, RT. And if you look at RT and its chart, okay, it seems like we had a little bit of a gap here. However, we've had a little bit, a really actually good fade off of that gap. So watch for their earnings. To me, RT is a little bit of a wild card that I really don't have much to tell you about that. Now, on Friday, home builders were actually very strong. However, the only reason they were strong is because they were overdue for a little bit of a bounce. So if you look at Toll Brothers, for example, it came into this 0.25 support level right here, and you see a little bit of support right here as well. So it was natural that it would reverse, okay? However, just based on the divergence, with the market, I wouldn't buy this here. It would be very, very dangerous to buy this here, especially if it starts consolidating sideways. You don't want to buy a stock like this. And I'm not going to go into the other ones, but the other ones are also into their pivot point supports and their fib levels. Look up Lennar, LEN, look up PHM, and all of those things. And just when you're drawing your fib levels, draw it from this top right here, and they all have a little bit of a bottom here around November. So let me just do this real quick to show you. So the way you would draw your fib levels on these is you would select this top in January 29th, around that time, and connect it to the November low, okay? And you will see, okay, that they have a little bit of support around this area where they are now, okay? Now, I originally liked this level. I remember a couple of days or maybe even weeks ago, I told you that this gap fill area was a very good level, okay? It was a very, very good level to buy the stock. And if you are in it, okay, I would go ahead and keep it for Monday, okay, because Monday does tend to be a good day. However, it is now a little bit risky. Like I said, be careful with your longs, okay? With your longs, you always want to go for the lower level, and I warned you. I said don't go for the 200, go for the gap fill right here, and it turns out that you should have gone even lower, okay? So now we need to see on Monday if we go even lower below this. So it's very hard to pick bottoms, on very weak charts like this. So that's what I'm saying. Be very careful with your longs, and always when you have charts like this with a market that's at all-time highs, keep your stops very, very tight. Keep your stops very, very tight. Protect your trade, and you should be fine. If you have a loser, that's okay. As long as you don't have a big loser, you're gonna make money off of the stock market, okay? I'm trying to see if I have anything else. I really don't have anything else to talk about. And as far as Monday, what to expect, well, I really don't know what to tell you, because we could get some news, something might happen. If I look at the spiders on the daily, the spiders have just been slowly kind of having these rounded tops. So we might have one more and then sell off. That's what I'm predicting. So we might have a little bit more upside into next week, okay? And obviously I was thinking that we might have off of this red bar, I was thinking that we might have a little bit of sideways consolidation and then ultimately break down. However, we gapped down on Friday because of the bad jobs data and because of FFIV and things like that, and we came into this little bit of support here. Okay, right now if the market goes lower, I wouldn't touch it at the 50 MA. It's not a very strong support level. I wouldn't touch it with the gap fill either. That's not a good support level either. Okay, so be very careful with your longs. As far as intraday, it's very hard to kind of give you intraday levels from a Friday into a Monday. But all we had a gap down, and as is expected on a Friday, we tend to float up on a Friday. Okay, so I wouldn't make much of this. Just watch your charts on Monday. Don't go off of what you see today, and we'll take it one day at a time.